Welcome back. We are all refreshed and ready with renewed energy to delve into the subject of responsibility and liability regarding credit damages.
Okay. Well, we were talking about the as a case study only, and it's just that raft of cases, and they're quite a range of looking at credit damage. The reason for its particular relevance is not just because it affects all of us, but also I've taken a few cases involving homeowners suing lenders, where the judge has turned to me and said, well, what is the damage? How has your client been damaged? He took out the loan, so, did your client get the money? Yes. Well, did your client pay it back? No. Couldn't, because the terms went from $800 a month to $4,000 a month. And could they get loan modification? Everyone has heard about these programs of loan modification, of which apparently a few hundred thousand people have been able to benefit from this out of the 50 million or so that would like to have their loan modified because they are in instruments that were inappropriately placed into. But I mentioned that the lawsuit might be the only recourse left, while loan modification was the win-win solution for everyone because it would get cash flow to the lender and would enable by reducing the payments or stabilizing the payments, would provide the certainty for the homeowner and give them something they could live with instead of having escalating monthly obligations. It would be a reformation of the option arm that they should never have been placed into. So you have that sort of benefit where both sides win. However, the fact is banks have not, the word is cooperated with loan modification programs of any kind, whether the first one done by President Bush, in which one homeowner qualified, and the ones done by President Obama, in which several hundred thousand people out of the millions have achieved some loan modification that they can live with. The fact is, those programs don't work. We're left now looking at possible litigation. And 2 years down the road, we're seeing an abundance now of litigation involving the investors who have lost their money and homeowners, many of whom who've lost their homes. Both groups have lost their credit reputation. Both groups have suffered derogatories on their credit because as the institutions destroyed themselves, the entire economy went down. Now, in terms of the litigation, the judges have asked me, with respect to a home loan, remember that example? A judge asked me, Mr. Key, did your client ever pay the loan back? No. Well, they received the loan money, right? Yes. So the borrower of money is obliged to pay it back, no question. But they can't pay back 10 times what they borrowed, and they can't pay it back if they've lost their job or if they've have other reduced circumstances, or they just can't pay the escalated amount back. But they can pay something. In litigation, many judges will have arrived at the determination, they'll do this to your case, if you can't prove that the borrower has sustained damages. Now that makes perfect sense. The borrower has to have taken some kind of loss. And you can't live in your house without paying either a mortgage or rent to someone, unless you paid off all the obligations on the house. Now, here, because of the nature of the paperwork that they were placed into, because of the nature of an option arm, the homeowner can argue that they were not able to pay the tripled or quadrupled installment. As a consequence, they were late on that obligation. The servicing bank, they see a late payment, they report that late payment to the credit reporting agency. And now the consumer who probably had pretty good credit, and in fact almost all of these home buyers had excellent credit before they were placed into these option arms. Certainly they had good enough credit to get a home loan from a bank. In other words, the bank at one point thought that they were good credit risks. And now they're not, because they have these derogatories on their credit. That injury alone is probably worth several $100,000. The credit reputation, if it's understood to be an asset, is the damage that the judges are looking for. And that's whether or not the person has lost their house, whether or not the borrower has paid the money back. They still owe the obligation. Some obligation, that's true. But it has not worked to get a loan modification, which by that I mean the removal of certain predatory terms from the option arm and replacing it with a new obligation where the homeowner is still buying or paying back the mortgage.
At an affordable rate.
Right.
At a qualified affordable rate.
But when I realized that, well, when my clients explained to me that their credit had been ruined, it began ringing the George Finder bell, and I realized this is the damage that judge is going to be looking for when they see a borrower coming against the lender trying to prove that they've been damaged, although they are in default. So you have to, that's the balancing and the presentation. This is not rocket science, and it's not subtle. This is a very clear case of enormous damage suffered by a borrower who has been placed into an instrument which cannot, on its face, be repaid in the circumstances in which it was underwritten. Now, whatever happened to that credit reputation of the borrower? He had very good credit when he took the loan out, and it's as if the instrument was designed as a foreclosure device. Even if there had not been a financial collapse, that homeowner could not, there's virtually no homeowner that could pay back an option arm. And again, that's, you can tell any lender.
As calculated.
Right.
Okay.
They can only be refinanced. You'd have to buy it out, and you don't even know how much you'd have to buy it out.
Right.
I've had expert witnesses who I will pay them to calculate the amount that is owing on an option arm who come to different numbers. And a third number would come from the lender itself. Now, again, it's that concept of liability that is so closely linked to accountability. And I want to emphasize that we can now talk about causation, or what caused the damage. For example, the damage we're talking about in this case study, or example this evening, the financial, well, I guess President Obama commissioned the Congress, and the Congress took him up on it, to investigate the causes of the financial collapse. And the report, long delayed, it was to come out last year, but it was delayed. Now 18 months later, the conclusion came out at the end of last month, with Congressman Angelides from California chairing it, and with a dissenting view from another California former congressman who served as vice chair. And in fact, the Republicans on the committee came out with a third conclusion. So we got 3 opinions out of that commission. I think the taxpayers got their money's worth there, Mr. Finder. 3 opinions on what the cause of the financial collapse was, and all 3 agree that the banks were involved and that the banks received the benefits from the collapse. All 3 opinions acknowledge the fact that the bank CEOs made unprecedented income, both in salaries and in commissions, on top bonuses for what they did. They took bonuses. What the opinions don't agree is that the corporations are culpable. That's true. But the majority did. The majority clearly said that there was corporate misfeasance, and on the part of everyone, including governance, including the U.S. Treasury, a failure to anticipate the consequences of what would be happening. And the majority clearly said that they should have foreseen the problems.
Would that be negligence?
It's more than negligence. When you are paying yourself billions of dollars, you can't say, oops, I made another $1 billion and destroyed my institution. You know, my bank is worthless.
But I have $400 million.
I filled it with toxic waste. Oops, I made another $1 billion. It's not negligence. It is, your attention is focused on what is good for you rather than on what is good for the institution or what is a long-term
So self-enrichment takes priority over regard for the employer or the institution.
Now, by using this illustration when we're talking about liability, it brings to the forefront the fact that liability is an accountability concept. Remember, liability is a legal concept. But it's really not an abstraction. And it has to do with accountability and holding the feet to the fire of the person who, would otherwise should be responsible for that fire. Fire is a good thing, but can be bad. And there is that link, and we suggest that focusing on recovery of credit damage from the people responsible for causing the harm enforces that link. It makes us have a more responsible society. To date, we still don't have an accounting from the bankers of what they did with the taxpayers' funds. The taxpayers and homeowners are the people who lost their credit reputations. They have suffered damage. The banks have recovered the funds. They took the money. Are they accountable for that? Now, over 700 witnesses testified in the congressional investigation. Thousands of documents. I want to emphasize that in this congressional investigation, there are only 2 kinds of evidence: witnesses and documents. You can ask for judicial notice and presumptions and other types of evidence, but these are the two fundamental things: testimony and documents. Now, the investigation gave the banks and Fannie Mae and the government and the U.S. Treasury Department that they focused on, the commission gave everyone a chance to testify and produce documents, tell their story. They gave them the chance to ask questions. They gave the dissenters, the congressmen or the commissioners, many of whom were very outstanding people, 10 people, outstanding people from the community. They're not all congressmen. But the ex-congressman from Bakersfield, the dissenter, certainly my personal favorite, the commission gave him every opportunity to participate in the investigation hearings, 700 witnesses. He could ask questions. He could call witnesses. He was one of the commissioners. He could subpoena the same documents from other people. If he didn't like the ones being subpoenaed, he could subpoena others. My point is that we live in a kind of a society that is ventilated. We depend on investigations that are open. These hearings were open. They were actually videotaped. And there are transcripts of the testimony. These things can be reviewed and peer-reviewed and questioned. The conclusions can be tested. And you can see for yourself, where is the evidence? Because I think, in spite of the dissenting views, there's a remarkable congruence and acceptance of the facts. And the facts just are not disputed. Conclusions are. But the lenders themselves have not refuted the facts. And they have actually come to the tables and pretty much admitted that they got the money and they did not see the collapse coming. What bubble? My favorite testimony was Greenspan, Chairman Greenspan, former chairman of the Fed. And he said, he was asked directly by Congress back in October, not in the commission this time. This dear man was asked if he saw this coming. You know, did you see a bubble forming in the housing prices? House prices were rising. And he said, no. I was shocked. I was surprised that bankers would disregard banking guidelines for making loans. And that the cause of the collapse was the disregard by the banking industry of loan guidelines, standard loan guidelines. Not government, not required by law, and there's a lot of law, and that may be bad, maybe government is terrible, but the cause of the collapse was the bank's disregard of their own rules. They had no rules. They had no guidelines.
No, but they did have guidelines. They didn't have enforced guidelines because
Right.
They
didn't have enforced guidelines.
Right. Okay. The guidelines were there. They've been there forever.
And the enforcers were apparently not
They were self-serving.
not on the job.
Well, yes.
Now, that's why we use that illustration this evening. When we're talking about liability, I suspect that the reason today, 2 years later, we still don't have a criminal prosecution, we still don't have a class action that has rolled up the flanks of the financial industry, which still dominates Congress, for example. But what they don't dominate and what they can't control is liability theory. They can't control private attorneys, we have a lot of attorneys in this country, and gradually, one at a time, attorneys will be suing these lenders because every homeowner, every borrower who has suffered credit damage can tell the judge, Your Honor, I lost the house or I didn't lose the house, doesn't matter. You know, that would be significant in terms of some damages. But Your Honor, I have suffered damage caused by the credit, caused by the banking industry, caused by the bank that placed me into an inappropriate loan that I did not understand and that I was assured would be refinanced for me when I needed it. Now that's the purpose of our illustration, is because I think by our failure to really adopt and really put our arms around the concept of liability, the concept of being responsible for the consequences that you have caused, is the explanation for why the system is a little slow to tackle this system, these banks that have destroyed the country.
Well, I have a couple of things I'd like to bring in. One is, if you're going to sue somebody, who are you going to sue? Are you going to sue the bank? Are you going to sue the loan officer? Are you going to sue the appraisal company that overestimated the value of the property? There are many instances of a property that at 9 o'clock in the morning was worth $100,000, and by noon it was worth $400,000 in the loan application, in the appraisal report, so that it could conform to the guidelines, the requirements of the lenders to qualify for the loan. From what I've read, if the documents, not including income, conform to the requirements of the guidelines, the loan was approved. And that's basically what the loan agents or officers were concerned with. Let's fill out this application to conform with the guidelines. We're not going to confirm your income, we're not going to confirm your assets, we're going to confirm that your signature is real. Probably.
Here's the...
So who do you sue?
Mr. Finder, this is a good introduction to our, the limitations to liability. For example, proximate cause. Who do you sue? Well, who caused the damage? And we'll talk about proximate cause and what types of ways of approaching it. And the first thing is, we live in a complex age, and I don't want anyone to feel intimidated by this layers of complexity. I can assure you that a lawsuit against a lender, although it exposes you to some complexities, if you just drive home the simple theories, the simple themes of this case, you will get success. Don't be intimidated by the complexity of real estate and the different instruments, the different alternatives, deeds in lieu of foreclosure, the process of foreclosure, all the laws, the truth in lending and RESPA, the Real Estate Settlements Protection Act. These are interesting, and there are damages, there are recoveries for attorney's fees. The real problem, though, and the solution is to focus on liability and the full damages suffered by a genuine victim. Don't and accept the facts. Drive into the facts. Pull facts, undisputed facts, admitted facts. The findings of the commission. The Congressional Commission made findings. Those findings are now available to every litigator in this country. Those findings came out just at the end of last month. Other litigation being brought by attorneys general. Their pleadings are not sufficient, but their pleadings, for example, People versus Countrywide, former Attorney General Brown in California, joined by 5 or 6 other attorneys general across the country, went to the trouble in this complaint of enumerating the facts of how Countrywide trained the brokers and how they marketed option arms. And the key here is that the option arm is a foreclosure device. It is not a loan. Nobody's ever paid it off. It is a device designed to seize the house. If you look at it any other way, you're probably not looking at the facts of its language. I'm a big believer in accepting the facts. Don't try to spin facts, don't try to hide facts, and don't be intimidated by what may appear to be complexity. For example, this liability question you raise here. Remember, causation is an element in a claim for damage. What caused the damage? Who caused it? And you can find cause. It's like physics. The defendant has to have done something, for example, that results in the injury to someone's reputation. It results in that. Basically, we can look at a record of the credit report. When we're talking about credit damage, number one, it's big. Credit damage is valuable. Second to the house itself, credit damage is probably the most valuable asset most consumers have.
No. Credit damage is larger than that.
And today it's no doubt larger.
Yes.
At first blush, some of this looks pretty complicated, but it's going to be very simple as you get deeper and deeper into this. Now, proximate cause is another legal term, like liability. And your case may involve a mix of duties of care, for example, unforeseeable consequences, intervening multiple causes. I want to just briefly introduce some of these concepts to you. Proximate cause is another word for legal causation. In other words, you have what's called the actual cause, or factual causation in fact, and then you have what's called the legal causation, which is proximate cause. Let's take actual fact first, or causation in fact, actual cause first. I like thinking about actual causation because this is where the universe is completely linked. You heard about the butterfly wing that took flight in Taiwan, and a year later there was a hurricane in Louisiana. These things really are related. but that, and you can look at how things evolve, how things develop, how they interrelate. But a lot of that actual fact stuff is lost on the law. The law, looks at legal causation in a different way than actual cause. Legal responsibility, first of all, is limited to causes that are related to the result that justice requires that liability be imposed. And so now we're introducing justice. Judges typically instruct a jury to make a finding that the defendant did something that was the proximate cause or actual cause of the injury.
Would that be the non-payment of the medical bill that we discussed earlier?
Yes,
or late payment?
That could be. Whatever caused that derogatory. Now, you see what I'm saying? The law makes it a jury question. The law, even when they're talking about legal causation, is asking the jury to make the finding. Lawyers can ask the jury, or ask the judge to instruct the jury, to make the finding of fact as to causation. In other words, the most complex and philosophically mixed kinds of questions are jury questions. This is a question of fact. Don't be thinking you have to be a philosopher. Juries are asked to make this finding.
But they must be presented a reliable, strong, evidentiary foundation.
Oh, sure. The jury has to believe it, has to have, we give them a basis for their finding. So we're looking for the facts that show causation.
Okay. And that's one of the responsibilities that the credit damage assessor will have, is to assemble that.
And here with whatever case you have, it's not just a question of what caused the credit damage, for example, that you're measuring. The cause, and you have layers of causation. The first cause is that a subscriber reported a default or a late payment, and the credit reporting agency put it into the credit report.
Yes.
So there it is. We have a record. So there's something almost unique about credit damage that gives you something to work with. You have dates and numbers and events that you can actually rely upon.
And they're conveniently organized, which makes it even nicer.
And people who can read the codes and see the chronology of a credit report will be able to measure the impact on the credit reputation, measure the harm. I want to, in terms of discussing causation, we also want to talk about how there are other types of injury or things that have caused a credit reputation harm. And the first one to look for is self-inflicted.
To disqualify.
Mr. Finder, what's a self-inflicted credit injury?
You get your regular paycheck. You decide going to Las Vegas and having a fun weekend is more important than paying your bills. You decide going out to the country club or the local bar and buying rounds of drinks for your buddies is more important than paying your bills. You make a choice. You have the funds, you have the ability to make the payment, but the choice is not to make the payment. Another aspect of self-inflicted is you arrange to lose your job. You put your employer in a position where they don't want to hire you. You're not employable anymore, and all of a sudden you have no income through demonstrable fault of your own. You have a drinking problem, you have a substance abuse problem, you have a romantic problem, and you're just not employable. And you no longer have a job, you no longer have an income, so all of a sudden you can't pay your bills. If it can be shown that this was manipulated by the employee, that's self-inflicted. There's also the context of there's 50 people in the department, business is down, and the employer decides to lay off half of the department. The employee did not do anything wrong, but there's unemployment or other sources of funds, and it's determined that there isn't enough to pay everybody, so you pay by choice, and depending on who you choose to pay, that could be a self-inflicted damage.
In this regard, one of the reasons we like talking about homeowners and their borrowing patterns in the last few years is that homeowners tended to be the segment of consumers who had the best credit reputation.
Yes.
These are people who were very good borrowers and good credit risks. And those are the people who were targeted for seizure. Their assets are now being foreclosed on. The strongest borrowers, the best people,
The most responsible people.
with the most wealth, the middle class of America had more wealth than the wealthiest people
Collectively.
as a group.
Yes. So the
So the fact that they have been taken from
Looted.
is not just significant on its own. It's the fact that the people who did it had targeted the biggest pile of money.
They targeted the money, they didn't care about the human consequences.
So it's not coincidence that they went after a segment that happened to be lucrative to go after.
Now, it's not necessary, by the way.
And this group did not have that self-inflicted injury that we had talked about.
No. It is
As a
not
group.
necessary for a reputation-damaged person to be a homeowner. It is not necessary for them to even want to be a homeowner. The point is, if they arrange their financial skills, paying their bills on time, not making more bills than they can afford, if they build a reputation that makes them attractive to a lender, and let's assume that it's someone who is in their mid-20s to mid-30s, if they're victims of credit damage and the opportunity to buy a home or to rent a better property is taken away from them due to inflicted loss of reputation, they are entitled to recover that reputation. It often will not be as large an amount of damage, but it will still be reputation damage. Okay?
Okay. Now, in terms of legal causation, the one test, it's really two tests here. The first test of causation is known as the but-for rule. It's, I think, in the Latin it was sine qua non, without which nothing. It is a rule of exclusion. Basically ask the question, would the damage have occurred if this event or the act of the defendant had not occurred? But for the defendant's act, would this damage have occurred? Now, the other test of actual causation is substantial factor, and this is used, although the but-for test will come across as the test for most of your cases. Substantial factor is also used, and in a sense, it's more appropriate for credit damage because credit damage occurs over time. Often it is damaged in a single event, but there are often multiple causes, and sometimes in your case a lot of different causation issues can be raised that would distract from the focus that you want to have on the defendant's acts. For example, one case that happened to me is a professional musician was injured in a car accident. He had a closed head injury which made him unable to remember the songs that he was playing. Now, his income from music sales, performances, stopped coming in. And he could no longer pay his obligations when due. He had credit card obligations. He had rolling credit that he had to pay. So he's no longer getting income from his performances. But he had already, in his company, had partners, investment partners. And when he was injured, they took advantage of his injury, his susceptibility, and they basically took control of his music company. They breached the agreement that he had with them. They stripped him of the royalties he had been receiving. So here we have two causations. We have the traffic accident, some negligent driver T-boned him in an intersection, and then you have his partners that are seizing his royalties. The injury is sort of the same. The big injury in his case was damage to his credit, because his closed head injury had almost no pain and suffering. He was unconscious for a while, didn't feel any pain, couldn't claim pain and suffering, and he recovered in about a month. He had the lost income, but that's not that long. So his big damage was that he, as a result of the breach of his partners taking the royalty income and his inability to work, he suffered credit damage. But who's responsible? His partners or the negligent driver?
Unfortunately, the credit damage assessor doesn't have to make that choice. That's the attorney's choice.
But the attorney can rely on the credit damage to help establish comparative fault, and where you have more than one agency causing the damage, you use the test. You have the but-for test, but you also have the substantial factor test. And in this case, we were able to show that both the partners and the negligent driver were substantial factors in causing the credit damage. And you could argue that even had the other not occurred, that each factor alone was substantial enough to have been the sole cause of the credit damage. We live in a universe of these things happening in infinite permutations. Generally now the courts will use a substantial factor test in this type of situation. The defendant's conduct is the cause of an event if it was a material element and a substantial factor in bringing it about. And again, ultimately, we ask the jury to answer that question. We go to the jury with these tough factual questions, and your job in terms of being a person who tries to solve these problems and bring justice into the world and compensate people that have been victimized is to get the facts in front of a jury. Now, there are other defenses, of course, which a defendant has available to them, not only by throwing up, causation defenses. In terms of what the actual cause was, they can claim that we had nothing to do with the injury. Defenses are important. We will be devoting an entire class to defenses. We're not here to encourage in any way frivolous claims by people that are not genuinely injured. I think all attorneys are interested in helping people that are actually injured and need help. Now, this touches upon another professional responsibility point. What is a professional? Why do we go to professionals? The two essential components of a professional is somebody who has the expertise that is needed by somebody who is dependent upon that expertise. Maybe they're injured. Maybe they just don't have the competence. Maybe they just don't have the education. Maybe they don't have the money. But the second element is that the professional has the integrity not to take advantage of that need. And this is the difference between the scammers. We saw it with the loan modification industry. When the state bar went after the attorneys who were helping homeowners, they shut down the attorneys. They shut down the professionals, leaving what? The entire market open for the non-licensed people claiming that they would do loan modifications for homeowners. They couldn't. They didn't. And many of those companies doing loan modifications or claiming to do loan modifications were scamming the consumers. That is a professional They probably had ability. I talked to many of them. They knew all about deeds in lieu of foreclosure and alternatives to loan modification and alternatives to foreclosure. They were trained by the lenders who, trained them.
To make the loans in the first place.
Right.
Yes.
The scammers were training more scammers. What was missing? The other side of the professional. In other words, you need to have competence and ability, skill, coupled with integrity. You need to have professionals that don't take advantage of the fact that people need their skills. And that's why, attorneys should be disbarred who offer to help and then just end up, like in the divorce situation, the two spouses can't figure out how to divide a house. An attorney steps in offering to solve that problem by taking the house. That would be somebody who is taking advantage of their need. They had a genuine need, but they went to somebody who was not a genuine professional. Now, that's probably, that point, if you think of a professional as somebody that can be trusted and who has the skills, that's the essential ethical requirement of a professional, and every person working with an attorney should keep that in mind. You're not going to take advantage or benefit yourself at the expense of the person who came to you for help. That brings us to the duty aspect, which is another way of looking at liability. Duties of care. And most attorneys will think about the famous Palsgraf case. And this is the case that in 1928, really at the peak of the industrial age in America. I always like thinking about these cases that involve the industrial age, because we're trying to move from the industrial age law to information age law. Most of our law is still in the industrial age. We barely are there. Palsgraf is still as interesting a case today as it was back in 1928. I'm talking about it tonight because, not only because most attorneys are familiar with it, but because as we talk about duty and the fact that we can address the issues of liability, who's liable, by talking about duties, who had the duty to prevent, mitigate, avoid the damage or the accident that happened. We look at these duties of care to try to help us answer this liability question. Credit damage cases almost always involve a kind of unforeseeable plaintiff. And in the case of Palsgraf versus Long Island Railroad, this is the 1928 case out of the New York Supreme Court, which is a state court, but here you had kind of unexpected injuries. I'd like to go through the following facts here. These are the facts that the judge gave us. Turns out they're fairly selective. Judge Cardozo was a very good judge, but he often would be caught up in the analysis, and judges try not to go inspect the actual premises. They rely on the attorneys. The attorneys certainly should have done that. But it turns out the facts of the case could not have happened the way Judge Cardozo described this case. I only mention that because this is where I think we can move from the industrial age of law to the information age of law. I think we can do a much better job of actually capturing facts instead of being captured by our imaginations and our brilliant analysis, the pomposity of the legal system often overwhelms the actual physics of what happened. And Paul's graph happens to be an illustration of that. Here you have unexpected injuries. How did they happen? Just to remind you, a passenger was running to catch a train. The train was operated by the defendant, the railroad, and a number of conductors working for the railroad tried to assist this passenger. And as they did that, the package the passenger was holding fell. The package contained fireworks. When the package fell on the railroad tracks, under the car, there was an explosion. The shock wave of the explosion, according to Paul's graph, this is what could not have happened, and I just emphasize that. But a heavy scale on the ramp fell over in this shock, or as a consequence of the explosion. What actually happened is a crowd of people got all excited, started running, and they pushed the scale over. The point is the scale fell over and hit the plaintiff. So the plaintiff is injured. The plaintiff is not the passenger trying to board the train. The plaintiff was a lady who was injured when the scale, a weight scale, fell upon her. Now, Judge Cardozo looks at this fact situation and says, the railroad wasn't liable for this because this was so
bizarre.
The passenger was being helped by the railroad. The railroad was, officers were trying to assist the people. The railroad couldn't be responsible for the scale falling over. They weren't responsible for fastening the scale down or even putting it there. So there was no negligent act toward this person who was injured. So the railroad was not liable to this person. Somehow this person, and in Judge Cardozo's words, is outside the zone of care, the zone of danger, and no duty running to this person from the railroad. No duty of care was breached, since the person who was injured was not a passenger, was not someone they owed a duty to. Most of us remember in law school that there was a minority view in this opinion, expressed by Judge Andrews. This is actually the majority view now, and it is actually growing. Judge Andrews saw it coming, and he said, using the same duty of care analysis, he accepted the idea that there has to be a zone, and you can have a duty of care that you owe to some parts of the world and not to some other parts of the world. But he held in principle, I'll quote here, everyone owes to the world at large a duty of refraining from those acts which unreasonably threaten the safety of others. In other words, due care is a duty imposed upon each of us to protect others from unnecessary harm that is within our control. That brings us squarely to the concept of responsibility. And you see the relationship between these two worlds. You have words. You have liability and responsibility. You have accountability. You have due care. And there's this mix. They are not analytically different from each other in the law. One way to put it is, if all the policy, the sociobiology, the problems with determinism, If this seems confusing, the essential legal nut to understand is that the law requires a determination of responsibility. We need to attach responsibility to the harm. We need to link those two together in order, why? To reduce the harm, to govern the harm, to make people care about the harm that they are causing. I can't overemphasize the fact that causation is the essential requirement to liability. There has to be a cause, but it doesn't determine it. And by that, for example, we'll discuss other defenses and problems of proof. But from the credit damage aspect, how can the plaintiff introduce evidence which will afford a reasonable basis for the conclusion that you're asking the jury to find that it is more likely than not that the conduct of the defendant was a substantial factor in bringing about the result? We'll take another break.
Good idea.
Okay, thank you.
Okay?